A major economic indicator just signaled a significant slowdown in U.S. economic activity. This indicator, called the ISM New Orders Index, has plunged down to the lowest level in over a year. That what looked like the beginning of an economic recovery in 2023 seems like it's making a 180-degree turn with potentially significant downside momentum, something that's typically only seen during actual economic downturns like 2008 and 2001. In fact, 50% of Americans today believe that the U.S. is already in a recession, with many news outlets being quick to call them misinformed. And it's true that when we look at the stock market, the S&P 500 index has been soaring higher over the last 2 years, consistently making new all-time highs. But maybe this new data point that we just got is actually going to prove Americans right, that the U.S. economy is actually on the edge of a recession today. Let's try to make sense of this very weird situation that's going on, with economic indicators like the ISM showing the U.S. is heading into a downturn, but the stock market showing us something completely different, and with Americans also being completely split on this matter. We're going to go through the best case and the worst case scenario, and also how we're preparing our clients at Game of Trades. At the end of the day, what determines whether the US economy is in a recession or not is GDP, so economic growth. During normal periods of expansion, GDP growth is between around 2 and 4%, which is a healthy annual growth rate. During recessions, of course, you see GDP decline to around 0 or even below 0 in full-blown contractions. Today, news outlets are right. GDP growth is at around 3%, which is a solid rate of growth that you typically see during economic expansions. That's where an indicator like the ISM New Orders Index comes in very handy, because it often gives a warning signal ahead, a warning signal that the economy is contracting before GDP actually goes down. This is what happened before the 2001 recession and the financial crisis. In fact, this also works with recoveries, where the ISM New Orders Index jumps long before GDP actually recovers. And so many people were watching this resurgence in the ISM New Orders Index, extrapolating that it was going to continue, and so that GDP would actually remain quite stable in the near future. And now these same people are getting very concerned about the fact that the ISM New Orders is turning back down. But to us, so far, this is all going according to plan, because the US economy has yet to feel the complete impacts of the rising interest rates we've seen over the last couple of years. Interest rates today are actually telling us that we're going to continue to see the U.S. economy weaken until June of 2025. When we flip this chart of interest rates and we add the ISM New Orders Index, we see there's a pretty strong relationship between the two. This is a chart that we've shown quite a few times before, where interest rates actually predict what the economy is going to do around a year and a half in advance. So in the best case scenario, we actually continue to see the U.S. economy struggle at around these levels until June of 2025. In the worst case scenario, which is the direction we happen to believe we're heading in, we see the US economy continue to weaken substantially over the next year, eventually causing a full-blown recession. Now, you're probably thinking, great, but what does that all mean for the stock market? After all, the ISM New Orders Index has been at relatively low levels throughout 2023 and 2024, and yet the stock market has moved substantially higher over that time period. That's because this indicator hasn't reached full-blown recession levels like we saw in 2001, 2008, and in 2020. We can see, for example, in 1995, we also witnessed the ISM New Orders Index hovering around similar levels to today, and the S&P 500 during that period was soaring. In fact, you can see the ISM New Orders Index eventually recovered, and the US economy never actually went into a recession. So this massive stock market rally that we saw in 1995 actually continued for another 4 years afterwards. So that would be what happens in the best case scenario that we just mentioned, where this ISM New Orders Index just continues to hover around these levels, and eventually in June of 2025 begins to recover. In that scenario, we could see the S&P 500 go on a 4 to 5 year bull market like we saw in the late 1990s. But unfortunately, best case scenario is not what we're expecting today. We do think that over the next year, we'll see this ISM New Orders Index dip below this recession threshold, just like it did in the 2001, the 2008, and 2020 recessions, all instances where the US stock market actually saw significant moves down. This chart that you see here shows us one of the reasons why we believe that's going to be be the case. It shows us that over the last year, we've seen small businesses hiring less people and beginning to think about laying people off. This is a behavior that we typically see leading into economic downturns. In 1995 and 1996, we never saw this type of behavior from small businesses. Back then, businesses were looking to hire new employees. Now, as you can also see, we've seen this chart show a weakening over the last 2 years, and yet the economy hasn't yet entered into a full-blown recession. This doesn't mean it's never going to happen, but it means that these things take time. It also took a couple of years of weakening before the recessions occurred in 2001 and 2008. It seems like it's taking a bit longer today, but our expectation is that by the end of the year, the US economy will be in a recession. Our trading strategy with our members has been to take advantage of this strong market throughout the end of 23 and the beginning of this year. As long as a recession does not materialize, we are in a similar environment to 1995 and 1996, where the stock market made a spectacular melt-up. It could be that that continues, and that's been our main narrative since November of 2023, where we want to have exposure to the strong market to make as many successful trades as possible with our clients at Game of Trades. Make sure to sign up to test our service out.